Okay, excellent. I'm going to ask the chairman for the group to just introduce himself and everybody else. So thank you very much.
Thank you. Well, good morning, everybody. My name is Mike Wardle from ZN. Welcome to this session, panel session around green and sustainable finance. We have a very distinguished panel on the stage. Rather than me spending a lot of time introducing them in a moment, I'm going to ask each of them to introduce themselves and introduce the two or three key issues that they think are the ones which we really ought to be focused on in terms of green finance. We'll try to keep the introductory session as brief as we can, because actually the interaction with you in terms of questions and answers is the more valuable part of the session, rather than us spending a lot of time speaking. We at ZN, as you've heard a bit from Michael, have been interested in sustainable finance and green finance for many years. And most recently we developed the Global Green Finance Index. The fourth edition was published on Friday. We were in Luxembourg. And Flavia Michelotto from the Green Exchange in Luxembourg joined us for that. In each edition of the Green Finance Index we include a supplement, a sort of special topic. And this one was on biodiversity, which is sometimes not given as much attention as climate in terms of the challenges facing the planet. But it's one which we do need to pay attention to, and one where finance has its own role. So without any further introduction from me, I'm going to invite the panel to introduce themselves and the two or three topics that they think are vital at present and the things that we need to be paying attention to. So if I could simply move along the line, Sean.
Sure. I'm Sean Kidney. I'm the CEO of the Climate Bonds Initiative, an NGO, international, focused on mobilising capital for climate solutions, in particular from debt capital markets. We work with institutional investors around the world as our primary stakeholder base. We also work with regulators around the world, central banks, notably the People's Bank of China, but also the Bank of England and various other central banks around the world, and with banks and, of course, bond issuers in terms of bringing to market. You will have seen some headlines around the green bond market, which is the area of our endeavour. We're going to hit about $250 billion US of issuance this year, about $1 trillion outstanding by the middle of next year on current trajectories. So it's what they call the fastest growing asset class, if they're allowed to call it that nowadays. But of course, there's still only a tiny part of the global bond market, which is about $100 trillion outstanding. You asked me to make 3 points. So the first one, for anyone in the financial sector, we need to be getting ahead of the risks of climate change. Mark Carney's talked at length about this. The Network for Greening the Financial System of now 48 central banks is examining the financial stability issues in the context of climate change going forward. Well, everyone who's in this market needs to. You know, we have a vast challenge. We are currently on track for catastrophic outcomes for the planet. Extinction Rebellion is perfectly correct in their prognosis. There's a risk of that. We're risk people, right? So there's a risk. Somewhere between 5 and 50% risk of species extinction, according to some climate scientists at the moment. So we're looking at that. But in the meantime, we see governments beginning to act. So the other material short-term risk is policy transition. Just to give you one example, China is acting vociferously to grow electric vehicles for state reasons and air pollution reasons. That is likely to lead to a crossover in price between electric and ICE in the next couple of years. And of course, there's a flow-on impact for everyone in the supply chain for ICEs, including the oil industry. We need to be ahead of that sort of risk going forward. And be ahead of the other thing, which is the opportunity for investments in the green wave that's coming through as a result of these policy changes. And you'll hear me talking on stages many times about $90 trillion that we need to invest by 2050 to make the transition, and that of course is a long green boom if we do it. There's a reasonable chance. So get ahead of the risk is one. 2 is, we are only now at about $0.5 to $1 trillion a year of capital flow into climate change solutions. We need to be at the $4 to $5 trillion a year level to be making reasonable headway. There's a big gap. Finance has to bridge that gap. We know that investors want to invest in green. I don't know how many rhetorical statements I've seen. And of course, whenever we see a green bond out, green bonds get oversubscribed at a higher rate than other sorts of bonds. There's plenty of evidence. The problem is pipeline deals and working of governments and potential issuers on financial viability models. This is the role of the finance sector. So we need to bridge that gap and make a difference. Of course, the last point, picking up Michael's point, is we need to be thinking about the financial sector repositioning. What is its role? Its role is not to make money short term, in my view. Its role is to contribute to society while making money, which is where we started in this game many, many years ago. Banks in particular need to reposition themselves. They need to ally themselves with institutional investors. They need to be thinking long-term, sustainable returns for those investors and their role in doing it. They need to become development banks. Development banks, real economy banks, whose job it is now to start thinking about bringing this deal flow to scale, which will not only give them good returns, but also address the challenge facing our species, which is the challenge of providing some kind of sustainable environment that our children can live in. Now that isn't too hard to ask, is it?
Thank you very much. Thank you. Moving down the line.
Hi, I'm David Harris. I lead Sustainable Business for London Stock Exchange Group. As part of that, I also head Sustainable Investment for FTSE Russell, which is the index part of the business. So maybe it's worth just explaining the group a bit and the relevance before going into my points. But so on one hand, we've got the capital markets part of the business, so that includes London Stock Exchange, also Borsa Italiana. And so a lot of the work there on this agenda is, for example, supporting green bonds. We were the first global exchange to set up a green bond segment, supporting issuers with their reporting, helping and encouraging to get better data to investors. Also renewable energy funds, ETFs, and also supporting green solution companies coming to market as well. On the index side, it's been about really supporting investors, helping many of the world's largest pension funds, sovereign wealth funds, integrate these considerations into their benchmarks. And there's obviously the join up between the two is to have the right data, indexes, and benchmarks. We need the right kinds of disclosure from issuers as well. So try and kind of join that up. And I was on the kind of HLEG, the EU advisory group with Sean and others as well. So we also try and work with policymakers to help make sure they're getting sensible regulatory and policy approaches here, because there is a bit of a danger of them all going off in different directions and actually being well-intentioned but not really helping the market. But my three quick points were, the first one I wanted to make was that the transition to a green economy is already well underway, and it's actually something we see as one of the biggest investment opportunities, but also some of the biggest investment risks facing investors today. So, give you some colour around that. The green economy is much, much more than renewables. We've developed this industrial classification system. We're also being quite excited by the EU work on taxonomies, which we think can support this. But where we've been defining 8 different green sectors, 133 micro sectors covering everything from advanced batteries, LED lights, companies building flood defence constructions, desalination technology. So this is very, very broad. These are all the different solutions that we need to address climate change and the environment and the other environmental threats that the world faces. And these companies and these technologies are going to have to grow very substantially for us to manage, to come up with the solutions that the world needs. Now, the size, we've also then been looking at what proportion of revenue the largest 15,000 companies in the world have across these green economy microsectors. And what we find is if you add all of that, so you take for each company, the proportion of revenue that comes from these areas, and you multiply that out, you can get a view of the total market capitalisation of this area. It's gone from about 8 years ago being about 5% of equity markets, and it's come up to about 6%. Obviously, markets have risen in that time, so in absolute terms, it's been a big rise. But over the same period of time, if you look at fossil fuel industries, if you look at coal mining, if you look at oil and gas, over that same period of time, it's gone from 12% of equity markets to 6% today. So we're actually at a really interesting crossover point. And this is now a very substantial part of the market. And it's being driven a lot by diversified companies rather than pure play specialists. So this is companies like ABB, Siemens, GE, Sony, and Green, all of them is between 20 and 40% of their business now. So second point is that investors are actually really getting this, and they are shifting their capital, and we see this. So initially the focus was much more on active management. It's now very much into passive investing as well. This is one of the big growth areas, certainly for us and our business, where we're designing a lot of these indexes for the passive portfolios for pension funds and sovereign wealth funds, where they're wanting to over-allocate to green industries, and they're wanting to reduce their allocation to companies facing some of the greatest risks from climate change. I'd say it's much more than rhetoric. So PGGM would be a good example. They've said by 2020 they're wanting to quadruple their exposure to green solution companies. They're wanting to halve the carbon exposure of their portfolios, and we're kind of cranking down the weights in the index all the time. It isn't just a European thing. We had an event last week in New York. We had Hiro Mizuno, the CIO of GPIF, the biggest asset owner in the world, who's making incredible changes with GPIF. There was also Tom DiNapoli was at the event, the state controller of New York, who's also the sole fiduciary of the New York State Common Retirement Fund, making big changes there. There's also corporate pension funds. HSBC pension funds done this now for the default fund for all of their staff. Again, it's focused on bringing in climate risk. So investors are really moving on this agenda, but the real question is the impact on the ground. If you have just capital reallocation in secondary markets, what real impact does that make? And that's where you need stewardship, which brings me to the third point, which is we've got to have much more effective engagement between investors and companies. We certainly see many of the, on one hand we're designing these benchmarks and can see the changes going on. On the other hand, we're talking to the issuers on our markets who've got no idea about the level of change that's taking place in capital markets. And so what we're keen to see is better engagement. There's some initiatives like you may have heard of, CA 100+. This is climate action with 100+ companies. Many of the world's largest investors all engaged in trying to collaborate so they're joined up in their engagement with issuers. We've been supporting a part of that called the Transition Pathway Initiative with Grantham Institute, come up with a very simple way to categorise companies as on steps 1, 2, 3, 4, depending on how well aligned they are with the transition to a carbon economy. Church of England now wants to use that to build into the indexes we're designing for them, to overweight and underweight companies based on how well they're doing on this. So there's a lot of exciting developments going on, but I think what's really going to drive it is joining up in that investment chain and helping companies and the long-term investors, particularly the asset owners, understand each other to help try and drive this.
Thank you very much. So there's real movement out in the markets. I think we're just hearing some of that. If we carry on.
Thanks, Mike. I'm Simon Howard. I'm the Chief Exec of the UK Sustainable Investment and Finance Association, UCSIF, for obvious reasons. We have about 214 members from all over UK financial services. We have London Stock Exchange Group, David is an ex-Vice Chairman. We have individual financial advisors, big fund managers, big investment banks, retail banks. So we touch UK financial services at myriad points. And what I think I'll talk about briefly is, I'll echo everything Sean and David have said. This is undoubtedly happening. Our members, they are the volunteers, that's why they come to us, but they are reporting real client interest, real growth in sustainability in its broadest definition. Michael called for innovation in his opening remarks. I think what I would say is what we're seeing and what I think we need is more evolution than revolution. I think sustainability techniques will be applied to every asset class. I don't think we necessarily need new asset classes, although we obviously welcome Sean Sterling's efforts. But really what we need is we need sustainability thinking applied to all the existing asset classes, excuse me, and that process is happening. It's driven by the data, it's driven by the thinking, which is evident in the very many initiatives we're seeing. Now, the good news is, certainly in London and increasingly around the world, the skills and the leadership exist to use this new thinking. In 6 or 7 of the leading markets have SIFs. We're not the only SIF. There are SIFs in America, Japan, France, Germany, Australia, all around the world. So the thinking exists, and the thinking is increasingly joined up. There's a lot of discussion about the EU taxonomy, about labels, about definitions. I don't think we've reached a consensus yet, but it's clear something is going to happen. 7 years ago when I took over at UCSIF, the message from the members was, please don't do definitions and labels. But there has been a sea change. I think there's now an acceptance that something is needed, and the debate now is about what. So the leadership and skills exist, and that debate is continuing. The final point I'd make, again I think echoing what Sean and David have said, is public opinion. Next week is Good Money Week, a campaign Oxford has now run for 12 years, and each year we do opinion polling. The results this year are absolutely fascinating. It's clear that the public support for things like Greta Thunberg, and if not the support, the toleration of the thinking behind Extinction Rebellion, people are now saying, when we ask them, what is your motivation in your finances, they are increasingly saying it is to make a difference. For the first 8 or 9 years when we did the polling, year after year, the most popular answer people gave for their motivation was, it's all about the money. It was the return was the first priority. That changed last year. Last year the most popular answer was, my priority is making money and making a difference. And that's great news. It shows the public is echoing the kind of thinking which my members are doing. It's possible to be a good steward, it's possible to make money, and it's possible to protect the planet. So it's exciting times. Now is the time. Delighted to have the chance to take your questions in a few minutes.
Thank you, Simon. Finally, Robert.
Thank you. I'm Robert Schaaf, the CEO of the Luxembourg Stock Exchange. Before I start, I need to make one comment. As a sustainable stock exchange, in fact, we are signatory of an initiative in Luxembourg which is called Equilibre, which basically prohibits me, in fact, from participating in a panel where, in fact, gender diversity is not assured. I got a derogation specifically, in fact, from the board of that initiative, because I figured out, in fact, that I am the diversity on this panel because I'm the only non-London-based representative. This being said, where are we coming from? In fact, Luxembourg Stock Exchange is above all a listing venue. In fact, one of the biggest worldwide, 36,000 instruments coming from more than 100 countries. Now, what's more important is how did you get, in fact, to sustainable finance? And I start with a personal conviction. In fact, when we looked at what was happening in the industry, in fact, I'm talking about 2014, 2015, when the Paris Agreement was coming up, and we came to the conclusion that maybe this time, in fact, something would more fundamentally change. And we believe that sustainable finance is the new finance. It will transform, in fact, the financial industry fundamentally. We are not only talking about a paradigm shift here, in fact, we are talking about a radical game changer. That's where we are coming from. That's where we believe, in fact, that it requires and it represents at the same time a fundamental change of behavior of all financial actors. And we see already happening. You can look at the banking sector, in fact, who already has introduced in many parts responsible banking criteria. Investors are changing their preferences. We see all of this is happening, and I do not repeat, in fact, what the previous speakers have said. So basically, we believe that the focus on sustainability has fundamentally increased. It requires, in fact, private and public money to move together, in fact, to make things happen. Now, whether you are following, in fact, or aiming at SDGs, or whether you are aiming at the Paris Climate Agreement, or whatever, in fact, the objective is, what's very clear is that we need to mobilize masses. And how do we do that? And that's the biggest challenge that we see. And our answer is it's all about education, not only of the financial actors, but also, in fact, of the individual, up to the individual investor. Education means, in fact, that you need to have access to information. And when you say information, in fact, you mean ultimately data. And I get to the point, in fact, where we are coming from. We created in 2016 the Luxembourg Green Exchange that was referred to early on. It's now 3 years ago. In fact, it has it's a dedicated platform for only green, social and sustainability financial products. We have roughly 50% market share, in fact, today of all these bonds. And we have an enormous amount of data available on our platform. And by the way, when you go into our website, in fact, you see that all of this data is available for free for everyone. Now, when you're getting access to all this information, what do you do with it? How do we create, in fact, this massive amount of unstructured data into structured data? Or I prefer the term meaningful data. Meaningful to everybody, in fact, in this room, and meaningful might mean, in fact, something different. So in other words, we need to extract from this massive amounts of data the points that really help you to make informed investment decisions. That's one of the key challenges where we are working on, and reference was made to technology earlier on. Obviously, in fact, AI is one part of the solution here in order to make this happen. A last comment, in fact, on data, because we are talking about projects and the impact of projects, but what we need to make sure also is, and it has been referred to partly already before, we need to make sure, in fact, that we're also talking about performance data of sustainable finance. Because what we still see out there is the myth of you need to choose between investing responsibly and having a decent return. In other words, in fact, you need to give up return in order to invest responsibly. This is not the case. There's enough evidence out there, enough studies have been made, and we need to grab this and make it clear to the investors, because that's what is moving the masses at the end of the day. If you understand that investing responsibly is not only ethical, but it's simply smart, because in fact you have a good return, you are contributing to a sustainable development, and ultimately, in fact, to whatever investment objective you had.
Thank you very much. So we've heard that things are shifting and moving, certainly from a European perspective. I mean, there's a question about other parts of the world, I think. But we see movement and change, and we see investors starting to put real money behind sustainability. That point about data, I think, is enormously important. You know, how do we take the enormous amounts of data the financial markets have and put them into easily digestible information that both retail and wholesale investors can respond to and understand. I was having a conversation with a senior banker in Western China a few weeks ago, and I was talking about green finance, and he said, but what about the rate of return? How can I possibly take this to my board? And so I was able to send them a whole lot of data saying, the rate of return information is there. There's education which we need to do, both in terms of investors, but also people in the financial service industry who yet don't believe that they can make a good return on sustainable and green investment. So, the panel has set out a number of challenges and issues for us, but we'd really like to hear questions and commentary from those of you gathered. So the floor is open. There's roving mics. So if you put your hand up, and we'll take questions in groups if we have them. And if you could say just your name and where you're from, that would be very helpful.
Good morning. Can you hear me? Yes. Lawrence from Q2I. I'd like to congratulate Sean on the amazing amount of time and effort they've been documenting what's happening with bonds. I've followed it since pretty much, I think, the second or third mail. And in parallel with that, people like Carbon Tracker who have been shining a very harsh light on the investment case for hydrocarbons in particular. But what I do see now is that there's an awful lot of people talking about free green finance in between institutions in Europe, for instance, green finance to invest in indices and all this kind of stuff. I just wondered when climatebonds.net is going to actually see if it can extract any quantitative information about how much of this bond finance that has been raised has actually been applied and turned into natural capital. As an adjunct to that, I'm an expert at the carbon finance unit at World Bank, and I've never seen them spend any money directly on a real project. So if I could leave that with you, if I could get your thoughts on that, sure, that would be very helpful.
Any other questions in response to that? While you're thinking. Sean?
Sure. Well, the first thing to note is bonds are a refinance instrument, largely. So you're not going to see a lot going to direct project finance. And as the Bank of England has said extensively, they want to see a large asset-backed market, which allows assets to be refinanced in the bond market, which will allow greater velocity in equity lending or bank lending up front. And that's really what we're trying to do with green bonds and climate bonds, which means you're not going to see a climate bond going into a fresh project so much. You're going to see it taking an asset that exists like a solar farm and then refinancing it, and the equity investor, someone like Foresight, for example, puts their money back into the next one. So that's how it works. So that's one answer. But the more substantive answer is around the relationship between this and natural capital. Clearly we have some huge challenges in natural capital. One is the link between capital markets and natural capital is pretty hard to make. Let's say Red 2 and Forest. How many years have you been trying to work on Red 2 bonds, for example? It's a very difficult game, and the instability of the returns and so on. We do have some challenges. We will see this year quite a lot of investment appearing in the green finance market in agricultural related investments. And that'll be land use stuff. The challenge has been getting rule sets. We just certified a bond at Climate Bonds Initiative from EcoAgro in Brazil, which is around sustainable sugarcane farming. And it does meet all the international criteria. You'll see that kind of stuff. That's not quite natural capital yet, but at least in the land use area it's happening. Where do we go for this going forward, particularly in existing natural assets, which is the real issue? It's going to come from sovereign issuance. If we can find some way to link the burgeoning sovereign green bond market to the mates of natural capital, which I do think is opportunity to do. It's also going to come from pursuing the Red 2 discussion and getting a price on carbon. Our own view is that one of the things we can do is look at a more narrow focus pricing game. I think we've been too ambitious with carbon pricing. It's been an elegant theory in search of a practical application. That's what's proven in the last few years. But we have a couple of things we could win. We could win in a couple of industries where transitions are very, very difficult, aviation and shipping. A carbon tax just in those industries and link that specifically to forest retention and a price against carbon. If we could justify a $10 a tonne price in at least the tropical rainforest, and I would restrict to that, that might actually provide some incentive for some bond issuance in the back of it, including by sovereign bond issuance. Brazil could be issuing sovereign bonds linked to an actual valuation of the Amazon, for example. So there's a lot of possible ideas going forward. I will say that your friends at the World Bank have been pioneers in trying to think this through, but the bond market is generally about financing and refinancing of hard assets and corporates. So the real question you're raising is what is the link between hard assets and corporates and natural capital, and that's a much tougher question. The real issue is what governments do, what sovereigns do, and how we might be able to use this to incentivise the public sector to do what it needs to do. And I'm going to say in a lot of places it is actually doing what it needs to do. We have an alliance with Amazonian states at the moment, trying to bring together to attention the world the really good work they've actually been doing, putting aside a lunatic president and encouraging people to break the law. So there are good stories there that we can use the public sector green bond market to highlight, which will help a little bit. Bit of a complicated answer, but thanks for the question.
Michael, sorry, the front here.
Thank you. With such a panel here, I'm curious about an area that I find overlooked. For the last 10 years, we've been pushing in law of finance policy performance bonds. Now, policy performance bonds basically pay a differential interest rate against targets, just like an inflation-linked bond. For 10 years, this was really ignored. The French government asked us, and we produced a booklet on it, where they're called obligation bonds. It's been an interesting topic, and people used to sort of push back at me and say, well, that's all theoretically nice. We've actually seen 3 of these in the last year. So Nokia issued one against climate change targets, against emission targets. Enel issued them against 4 SDGs, and Louis Dreyfus issued one against a variety of self-assigned targets. Now, I find these far better. I don't need to have a bond imprimatur or anything. This is easily auditable, so I cut away a lot of the costs of the bond certification area. And the second thing I'm quite interested in, and we've been pushing this as well, is rather than trying to reach some type of global agreement, if governments were to issue these bonds themselves, so a bond that, just to be clear what I'm talking about, the UK government has said 0 by 2050. That's 30 years. You can straight line that. 3% a year. If it's above the straight line, it starts to pay more interest. If it's below it, it pays effectively zero. But these are excellent hedging mechanisms for me against government policy. And further, they're bonds that I can use to tackle sort of some of the international trade issues. So if I'm trading with another nation, I'm able to look at it and say, if you've issued a bond on the open market with comparable target stars and the price is like ours, then clearly you are meeting your carbon targets in ways that we are. I'd be very curious to have the panel's thoughts on this. Thank you.
Who'd like to start? Robert, have you had ideas on performance bonds?
Well, the couple of interesting ideas, in fact, which were referred to, in fact, first of all, in fact, what's the role of governance, and I would include, in fact, the supranational, or the SSAs, as we tend to say, in the market, and basically you could argue that they shouldn't issue any one of the green bonds or social or sustainability bonds, because basically, in fact, all of what they do, in fact, should aim at exactly this objective. Especially, in fact, if we want to meet, in some instances, the 2030 or the 2050 objectives overall. That's one element which is currently being debated in the market, and I think, in fact, we will see more of that moving forward. Now, for these performance bonds, in fact, I find we have plenty of leeway in the traditional or the conventional financial instruments. So in fact, basically, we are convinced that all financial instruments can be issued in a sustainable way. So there's plenty of room, in fact, to maneuver there. But if this type of financial innovation would be required or make sense, in fact, in specific situations, in order to create more awareness and also more encouragement, in fact, of others to move that way, I think it's a perfect way of gaining attention in the market.
You are incredibly persistent, Michael. I think you put out the paper 8 years ago, was it? Maybe even 9?
Well,
No. We can't. You and I can't be that old. So my view is, look, anything that works, we should try.
Yeah.
And the question is, who will try it? I will tell you, as we have discussed for the last 12 years, that the appetite amongst institutional investors for complex coupon bonds, let's call it, or variable coupon bonds, is, I find, extraordinarily low. That they want vanilla. Now, they want vanilla with added benefits of it goes towards green. This is what I see as the dominant demand. And that's a green bond, if you like, which meets the credit characteristics and the yield characteristics of any other bond because of bonus feature. So the bulk of the market is likely to stay that because of the way we regulate our financial institutions, their understandings of risk and yield, and so on. So sell it. But in the meantime, I think at the margins, and I'm going to say it's the margins, there's lots of scope to do that. I thought the NL bond was very interesting, for example, as a way of locking in, and it was interesting how well it was placed. So maybe it is time for that sort of thing to start. I can see governments, though, are going to remain resistant for a while now, because essentially you're asking them to make a bet on future political volatility. God knows in the UK they would be mad. So this is what we're up against in a public sector sphere with changing governments. China might do it. They might be able to predict their public sector outcomes with more certainty going forward. So I'm very dubious we're going to see it out of the public sector, I have to say. But I agree with you. The fact that we've seen these 3 issues from the corporate sector suggests that perhaps there's a movement there. We might see a lot more this year. And funnily enough, I was in New Zealand 2 weeks ago, and all the New Zealand bankers were cock-a-hoop about this. And they were saying that performance-linked loans was going to be the dominant theme in that country because bonds weren't really a market. And, it could be your time.
Yeah. Maybe let me add a couple of reflections as well. So we're currently doing this a consultation looking at the different sustainable bond segments and thinking about because there's quite a few different innovative ideas coming through. Although this has been in the works for 12 years, it sounds as if it's not that new. But in terms of maybe the actual issuance, where we can actually then start to have some segments. So there's a discussion going on currently where we're looking at how we can support some of these areas. But I think we're bringing it back to where are you really going to impact broad markets. And what we've seen is most of our efforts today have been focused on more in terms on the index side and the equities. something which we did this year, we acquired a firm called Beyond Ratings, a French research firm that's focused particularly on fixed income, but particularly on sovereigns. And we also calculate the most followed government bond index, the World Government Bond Index, which is hugely followed by many large institutional investors. And we've created a climate-tilted version of the World Government Bond Index. And the interesting thing is then investors starting to reallocate based on climate risk at sovereign level and some of the engagements with governments around this. 3 different measures. One is what we call distance to target. So this is what's a country's current emissions reductions going on? What do they need to achieve to get down to close to zero by 2050? And so, for example, UK is reducing 3% a year, needs to reduce by 3% a year. It's going to get much harder very soon, but currently it's looking good. US needs to reduce much more substantially. I think it's 4 to 5% a year, but is reducing only 1%. So one is distance to target, how far off that target. Second part is physical risk, which then looks at level of economic activity around regions close to the sea, looking at level of agriculture, etc. The third element is looking at resilience. What kind of forward plans has each country got to be able to try and transition their economies? So this potentially starts to address that, but obviously through the vanilla market rather than through the green bonds or the policy-linked bonds.
Can I just comment? I think it's a very interesting idea. I hadn't heard of it. I'll go away and look at the bonds. I think what we need to recognise is, although the leaders are doing great work, and I've already said the skills and the competence exists, in the UK, UCSIF's focus over the past 5 years has been getting a very basic change in the pension regulations, such that trust-based pensions now need to state what their policy is with respect to ESG, including climate change. So in a sense, our big effort has been just to get it on the trustee agenda. In terms of the kind of advanced, what do we do with it? Yes, it's great the leaders are innovating, but I reckon it's, within a month I will meet a trustee who is still sceptical about the return argument, and I'll have to hammer home the fact they're now required by regulation to do it. There are a lot of the mainstream still at the very beginning of this. And that should be, I think that's what David was saying, we need to focus on that, and if we can change the benchmark indices, that's a great step.
So there's a challenge for all of us to educate one of our colleagues and friends who isn't yet in this space. Other questions? Thank you.
One of the issues, I suppose, with any fledgling markets is liquidity. Is the market just happy with buy and hold, and they're paying lip service to a certain sort of allocation? Or is there a case for looking at something like maybe tokenization for cross-market fungibility of various different bonds in different sectors?
In the green bond market, we have a very liquid market in USD and EUR. Other currencies are a bit challenging, or renminbi, there's a bit of liquidity. In fact, if we put out a pricing report every 6 months, and you can see our tracking of secondary market performance, there's certainly plenty of trading going on, plenty of price discovery. That's very important to know. This is now large enough. As we approach $1 trillion outstanding globally, we've split a quarter US, a quarter euro, and a quarter renminbi, and the rest in multiple other currencies. That's not too bad a size, and it keeps growing. So I don't think that's an issue at the moment. Yes, there are a lot of buy and hold characteristics amongst insurance funds, but it's not stopping some trading. Where we do see liquidity problems is when there's a downturn. So when there's a downturn, people hang on to it because they're worried they're not going to be able to buy them back to fulfill their mandate. And what you see, which is a lovely feature, is that green bonds hold their value and other bonds go down. Now, of course, that means we're crowding more investors in who are looking just for value retention rather than the green factor, which is an interesting feature of the market. Do we want more liquidity? Well, we want more bonds. And as we get more bonds, we will clearly see more trading. So that's the answer. That's my response to the liquidity issue. I'll be interested to see whether Dave or Robert see that happening at their exchanges. Of course, they may have a different view in their particular market. But that's what our tracking of the market is. I do want to say that one of the interesting features of that liquidity is green bonds traded at a premium. That is, they are worth more in the secondary markets, despite having reasonable liquidity. I thought that was because of lack of trading and relative scarcity. but the academics I've consulted say the liquidity indicators they've got suggest that in fact there's no real lesser liquidity for green bonds in secondary markets. So this is interesting. I'm still trying to get to the bottom of rationale for that. But that is a feature we pick up, very clear premium performance in secondary market, which of course is driving primary price down, which is a lovely feature for the issuer. Over to my colleagues at exchanges.
Yeah, I mean this is an issue. I think particularly for corporate green bonds in particular, where there has been a bit of a lack of liquidity. It's for very positive reasons, and that effectively demand is massively outstripping supply. So I mean, ideas on how to start to create some liquidity. I mean, obviously it will grow, as Sean says, and it has grown. We've got part of the group is MTS, which is is a trading facility which encourages kind of liquidity, and certainly we've had a bit of a focus there around green bonds to try and support some improved liquidity. But yes, I'm very open to ideas and keen to discuss afterwards as well.
I can add two comments. In fact, the one is we have not come across any investor, in fact, so far who would say, in fact, I don't buy green bonds because of their illiquidity. And it's typically a buy and hold market for the time being. But having said this, I talked about mobilizing the masses, so we care about retail. Retail is basically excluded from the primary market of green bonds. So what we introduced now, in fact, and you go to our website to find that, we are listing, in fact, currently 300 green bonds, roughly, and 12 of them, only 12 of them we trade on the fixed price basis in the size of 25,000 euros. Fixed price, you can trade. It shows it's very small, but it's basically, and we are doing this in order to allow retail at least to grab a small piece of green bonds, just to avoid that they are being excluded or that they only get access to by buying investment funds or whatever have you. But I think it demonstrates very clearly, in fact, how small liquidity is.
I think I'd pick up on that point. So in the UK, there's quite a buoyant, small, local scale sustainable investment thing going on. And the issue is how we can make that available to more investors. The FCA is concerned about liquidity. The Woodford position doesn't help that. They put out a paper yesterday, I believe, on illiquidity as a kind of classification thing. So there's work to be done there. My personal hypothesis is there are many reasonably wealthy people who would invest locally almost on an impact basis because they will put something back into their community. And we need to make it possible for them to do that. And the reason we need to make it possible is because no financial advisor would kind of sign off on what they wanted to do. You know, putting half of their net wealth into the local biodigester makes no sense as an investment strategy, even though it's what they want to do. So there are these issues in the retail market more broadly, but I think there's a lot of money available there by motivated investors, and there's a medium-term objective of freeing that up.
Thank you very much. We've come to the end of time for this session. We have a refreshment break now for tea and coffee. I'm sure if you have other questions for the panel, they'd be happy to mingle with you over a cup of coffee. But if we could just thank the panel, please. So and to thank you for your questions. So coffee is next in the line.